Okay, so welcome everyone, I'm config.json, and today I'll start a different topic for my channel, and that being derivatives in general, theoretical concepts mostly, but practical ones as well. As with the rest of my content, I will start going over the easy part just so I can explain the more complicated one. Before starting, don't forget to subscribe, like, and follow me on Twitter. So in first place, and oversimplifying, a derivative contract settles its price based on an underlying asset and gives you the right to buy or sell that asset without having to own it. So basically you can buy BTC without having to own a BTC. Okay, which sounds quite logical for now. Historically, this has been used for thousands of years in the commodities market to facilitate trade. This system extended in the next many centuries towards the rest of financial markets. I'll be focusing on crypto since that's what we trade, and that's what I assume most of us know already. You can easily buy spot crypto compared to buying physical gold, for instance. But there are other purposes to trading derivatives. That's speculation, of course, and hedging. When it comes to crypto, there are two types of derivatives, futures and options. Futures are generally easier to understand than options, more used in crypto, but less flexible than options. So now we go into futures, which was what I was trying to explain in this video. We'll start with delivery futures that are effectively bets that price will be above or below the current one before a specific date. The breakdown of a contract of delivery futures will be something like this. So if we first go to the chart here, we see we got an expiry on September the 29th. So that's the quarterly expiry. So now we'll go back here. That means all your positions will be closed by that date. But of course you can close them before that due to available liquidity in the market. So here, let's say the buyer or the long position buys 1 BTC, okay, and hold it until expiration. The seller or the short sells 1 BTC to the buyer and holds it until expiration as well, which is September 29th. We see it's filled at 39.20. Okay, so at expiration, the buyer that bought 1 BTC has to sell it back and the seller has to rebuy it from the buyer. That's a derivatives contract. When a buyer gets matched with the seller, a new contract is created. So in summary, the only difference we've seen until now compared to spot, which is normal buying and selling, you own the underlying, is that both parts of the contract are willing to close their trade before or at the specific future date. So in this case, both parties are willing to close their trade until September the 29th, which doesn't happen when you buy BTC on spot. You just buy and you don't have cleared the moment at which you sell. Or you sell and you don't have clear the moment at which you'll buy. Anyway, delivery futures are barely traded in crypto. I just use delivery to explain the base of the futures, how they originated. In crypto, we trade perpetual futures, or also called perps. As their name could hint, there's no expiry date to the futures contracts. And in this case, the buyer and the seller just agree to make the trade at a future date without that being defined like in the delivery futures. It's just a future date. And due to the available liquidity in the market, both the buyer and the seller can be matched with someone else to close their obligation and realize their profit. So here in the delivery contract example, we saw they're filled at 39.20. So if by September the 29th price is below 39.20, the short made a profit and the long made a loss, and the vice versa. So if price is above, the buyer that bought 1 BTC now and sells it on September 29th made a profit, and the seller or the short made a loss. So due to that liquidity available, both the buyer and the seller can close their obligation, can close their position and realize the loss whenever they want. But then what will be the point of trading perps against spot, since it's the same thing? There's no expiry, there's no nothing, and that's mainly leverage, and as we said, for speculation, but also works to hedge, to manage risk better, and subsequently there will originate arbitraging opportunities between spot and futures. While trading spot, the only way to increase your position without increasing the money you have or collateral, so the only way to borrow money is by taking a loan. And most big exchanges currently do offer loans as well, also under the name of margin, but they are not nearly as flexible and powerful as leverage on a futures contract. So leverage is in short a tool that lets you borrow money from the exchange to take a trade, which is not as widely available in spot, but it is in perps and it is in delivery futures. So here in this slide are listed the main benefits of leverage. And the first one, again, is the power to borrow much more money, up to 125x. And that depends on the exchange, and that depends on the asset. For example, BTC and ETH will have a higher leverage than other alts. And don't get me wrong, if you use it the wrong way, you can easily lose your money, okay? So if you're just new to this, try to test with something you can lose. It's general advice I've been giving on this channel for a long while. But if you use it correctly, and I will teach how to do this in future videos and future episodes, then it's a really big advantage. Second will be the ability to short without having the underlying. So the ability to sell BTC without having BTC, because you take borrowed money, and when you enter a short, you basically borrow BTC which you sell instantly, and you try to rebuy at a lower price. If that sounds a bit too complicated, just keep in mind you can short without having, you can sell without actually having BTC. And then other margin management tools which are not explained here to keep it simple. In conclusion, there are two types of futures contracts: delivery, in which the contracts are closed at a certain date, and then the perps or perpetuals, in which the contracts are closed at an undefined rate in the future. In crypto, delivery futures are barely used and most times ignored, while perps play the main advantage they present against spot or buying and selling the asset directly is that the former have easily accessible high leverage, but if used unhealthily, really good if used correctly, and more flexible margin management. A derivatives market used for speculating in first place can also offer hedging tools and subsequently arbitrage opportunities. Both hedging and arbitraging need a good grasp of how futures work, and will be explained more in detail in the future. So I hope you learned something from this video. I hope you understood the basics of futures. I didn't want to make it really long, I just wanted to explain that futures are basically spot with leverage, and you're not actually trading the underlying. You're trading a contract based on the underlying. So that's the main idea if I had to summarize the summary. Again, subscribe, like, follow me on Twitter, and I guess see you in the next one.